Gold crashed 21% in 3 days. Retail investors panicked and sold everything. Meanwhile, institutions poured $19 billion into gold ETFs in January alone. That's a record month. Every major bank just raised their price targets. JP Morgan says $6,300 by year end. Goldman Sachs says $5,400. Deutsche Bank says $6,000. UBS says $6,200. Bank of America says $6,000. When retail is running for the exits and every major bank on Wall Street is raising targets, something doesn't add up. Here's what the smart money sees that you don't. My name is Alex, and I've spent the last decade tracking commodity cycles and central bank policy so you don't have to. I read Federal Reserve minutes and sovereign debt filings at 3 in the morning because I genuinely find this stuff fascinating. And what I'm seeing right now in the gold market is one of the biggest divergences between retail panic and institutional conviction I've witnessed in 15 years. If you want to understand what's really happening in precious metals and why the next 6 months could reshape your portfolio, make sure to hit that subscribe button and give this video a thumbs up if it helps you see through the noise. Before we dive in, I want to know, what's your gold price prediction by end of year? Drop it in the comments. I'm genuinely curious where this audience stands after everything that just happened. Here's my thesis. The crash wasn't a trend reversal, it was a positioning reset. Every single structural driver that took gold from $2,000 to $5,600 is still intact, and the smart money isn't just holding. They're buying the dip more aggressively than they've bought anything in over a decade. By the end of this video, you'll understand exactly why they're so confident, what could kill this rally, and how you should actually position yourself if you believe the bull case is real. Let's start with what actually happened. Because the narrative you're hearing on financial television is missing the most important part. Gold hit an all-time high of $5,608 per ounce on January 28, 2026. That's according to data from Light Finance and Trading Economics. 3 days later, it had dropped to around $4,400. A 21% decline from the peak. That's violent. That's the kind of move that makes people question everything. Silver was even worse. On January 30, silver dropped 36% intraday. That's the worst single-day drop since the Hunt brothers tried to corner the silver market in 1980. Then on February 5, silver plunged another 20% to below $71 per ounce. If you were holding leveraged positions in silver, you got obliterated. So what caused it? Two things happened simultaneously. First, Kevin Warsh got nominated as the next Fed chair. Warsh is seen as an inflation hawk. The market interpreted his nomination as a signal that interest rates might stay higher for longer or even go higher. That's traditionally bearish for gold because higher real rates increase the opportunity cost of holding a non-yielding asset. Second, there was a massive unwind of leveraged long positions. The CME raised margin requirements on gold and silver 3 times since January 13, according to Yahoo Finance. When margin requirements go up, leveraged traders are forced to either post more capital or liquidate positions. Most liquidated. That created a cascading sell-off. But here's what the headlines didn't tell you. This wasn't a fundamental shift. It was a positioning reset. The leveraged speculators who got flushed out were the froth on top of a much deeper structural bid. And that structural bid never left. Let me show you what I mean. In January 2026, gold ETFs saw $19 billion in inflows. That's a record month, according to the World Gold Council. North America alone accounted for $7 billion of that, marking the 8th consecutive month of positive demand. Gold miner ETFs saw their largest monthly inflows since 2009, according to Crux Investor and CNBC. These are not retail panic buyers. These are institutions building positions. And here's the kicker. Most of that buying happened before the crash, but the buying didn't stop after the crash. On February 4, gold rebounded 6% in a single day. That was the strongest single-day gain since 2008, according to Trading Economics and Finance Magnates. Gold pushed back above $5,000. As of February 6, gold was trading around $4,931 per ounce. That's up $116 from the previous day. And it's up $2,071 from a year ago. That's a 73% year-over-year gain, despite the crash. Think about that for a second. Gold is still up 73% year-over-year. It nearly doubled since Trump's inauguration, according to Al Jazeera. Silver is up 146% in 2025. Gold is up 64% in 2025, according to goldsilver.com. This isn't a bear market. This is a bull market that just had a violent correction. Now, I know what you're thinking. If this was just a positioning reset, why did it happen so fast? Why was the move so extreme? Because leverage amplifies everything. When you're long gold on margin and the price drops 5%, you don't lose 5%. You lose 20%, 30%, maybe everything, depending on your leverage ratio. The CME knew this. That's why they raised margin requirements 3 times. They were trying to de-risk the system, but in doing so, they forced a liquidation event. The traders who were using borrowed money to bet on gold going up had to sell. The price dropped. That triggered stop losses, more selling, more liquidation. It's a feedback loop. But the institutions buying physical ETFs and building long-term positions, they didn't have to sell. In fact, they used the dip to add more. What I'm about to show you next is the thing that took me years to understand, and it's the reason I'm not worried about this pullback at all. The bull case for gold isn't based on speculation. It's based on structural forces that haven't changed. Let me walk you through them one by one, because when you see how these pieces fit together, you'll understand why every major bank just raised their price targets even after a 21% crash. First, central bank buying. This is the floor under the gold market. In 2022, 2023, and 2024, central banks bought over 1,000 tons of gold per year. That's more than double the average of the prior decade, according to the World Gold Council, VanEck, and Amundi. In 2025, central banks bought 863 tons. That's the fourth largest year on record. 22 institutions added at least 1 ton each. Poland was the #1 buyer in 2025. They added 102 tons. They now hold 550 tons, which represents 28% of their reserves, and they're targeting 700 tons. Brazil re-entered the market in 2025 and added 43 tons. Azerbaijan added 38 tons in the first half of 2025. Turkey added 27 tons in 2025. China officially reported adding 27 tons in 2025, but analysts believe the actual purchases are 2 to 3 times higher than disclosed, according to the World Gold Council and Gainesville Coins. India now holds gold as 12.1% of its forex reserves, up from 8.9% in July 2024, according to Caratrade. Central banks absorbed more than 20% of available supply in 2022 through 2024, and about 18% in 2025. Total annual supply is roughly 3,600 tons from mining, plus 1,200 tons from recycling, according to Gainesville Coins and the World Gold Council. Global official reserves now stand at 36,359 tons total as of September 2025, according to the World Gold Council and IMF. JP Morgan forecasts that central banks will buy 800 tons in 2026. That demand isn't going away. And here's why it matters. Central banks don't panic sell. They don't have margin calls. They're not trading on leverage. They're buying gold as a strategic reserve asset because they're worried about the stability of the US dollar and the weaponization of currency reserves. Remember what happened to Russia? After the invasion of Ukraine, Western governments froze over $300 billion of Russian reserves. That was a wake-up call for every central bank on the planet. If your reserves are in dollars and held in Western banks, they can be frozen at any moment for political reasons. Gold held in your own vaults can't be frozen. It can't be sanctioned. It has no counterparty risk. Diego Franzen from Planisphere Investments put it perfectly. He said gold is the only asset without a counterparty. It makes no promises, pays no interest, and is not dependent on political decisions. That quote is from Al Jazeera. That's why central banks are buying. And that's why they're not going to stop. Second, the US dollar is structurally weakening. The US national debt is now $38 trillion, according to Al Jazeera. The deficit is over $2 trillion per year. The Fed is stuck between a rock and a hard place. If they keep rates high to fight inflation, they risk breaking something in the economy or the financial system. If they cut rates to support growth, they risk reigniting inflation. Either way, confidence in the dollar erodes. And we're already seeing it. The Polish zloty is up 14% against the dollar year over year. That's not an isolated case. The same story is playing out globally. The dollar index has been declining, and that decline is accelerating. VanEck described what's happening as a shift in currency regime unlike anything in a century. They compared it to the transition from the British pound to the US dollar as the global reserve currency. When the dollar weakens, gold goes up. It's that simple. Gold is priced in dollars. When the dollar loses value, it takes more dollars to buy the same ounce of gold. Third, real rates are still negative or barely positive. The Fed funds rate is currently around 4.5%. Inflation, depending on how you measure it, is somewhere between 2.5% and 4%. That means real rates are between 0 and 2%. Historically, gold performs best when real rates are negative or low. And even if the Fed doesn't cut rates this year, real rates are unlikely to spike above 2.5% without triggering a recession. Fed Governor Lisa Cook said she won't support additional rate cuts right now, according to Trading Economics, but the market is still pricing in cuts in June or September of 2026. Why? Because the labor market is weakening. U.S. job cuts in January hit 108,400, the highest for the month since 2009, according to Trading Economics. Initial jobless claims came in at 231,000, well above expectations. If the economy slows, the Fed will cut. And if the Fed cuts, real rates go lower. And if real rates go lower, gold goes higher. Fourth, geopolitical uncertainty remains elevated. Yes, the US and Iran agreed to nuclear talks in Oman on February 7, which temporarily reduced the safe haven bid for gold. But that doesn't mean geopolitical risk is gone. The war in Ukraine is still ongoing. Tensions with China over Taiwan are simmering. The Middle East is a powder keg. Any escalation in any of these theaters sends gold higher. And fifth, the investment banks are still overwhelmingly bullish. Let's go through the targets again, because this is important. JP Morgan is calling for $6,300 by Q4 2026. That's their boldest forecast ever, according to finance magnates and Al Jazeera. Goldman Sachs says $5,400 by December 2026 with significant upside risk, according to CNBC. Deutsche Bank says $6,000 is achievable this year, according to finance magnates. UBS is forecasting $6,200 for Q1 through Q3 of 2026, and $5,900 by year-end, according to CNBC and a UBS CIO note from January 29. Bank of America Securities says $6,000 in the coming months, according to CNBC. The consensus range among major banks is $5,400 to $6,300 by year-end 2026. These are not fringe analysts. These are the biggest banks on Wall Street, and they all raised their targets after the crash. We're halfway through, and honestly, the best stuff is still coming. Because what I'm about to explain is the part that most people miss. It's not just that the fundamentals are intact. It's that the crash actually helped the bull case. Here's why. The crash flushed out the leveraged speculators. Those are the weak hands. The people who were betting on gold with borrowed money because they saw the price going up and wanted to get rich quick. When the price dropped, they got liquidated. They're gone. What's left are the strong hands. The institutions. The central banks. The long-term investors who understand the structural case and aren't trading on margin. This is a healthier market now than it was in January. The positioning is cleaner. The froth is gone. And the buyers who are stepping in now are doing so with conviction, not momentum. Gold miner ETFs are seeing record inflows. The largest monthly inflows since 2009, as I mentioned earlier. Why does that matter? Because gold miners are leverage plays on the gold price. When gold goes from $4,000 to $5,000, the miners don't just go up 25%. They go up 50%, 60%, maybe more, because their costs are fixed and their margins expand dramatically. The all-in sustaining cost for gold miners averages around $1,600 per ounce, according to VanEck. Gold is currently trading around $5,000. That means miners are earning roughly $3,400 per ounce in margin. Those are record margins. And yet, gold miners are still fundamentally undervalued relative to the metal, according to VanEck. Miners were up over 120% in 2025, but they haven't kept pace with gold's move. That gap is going to close. And when it does, the miners are going to rip. So that's the bull case. Central bank buying provides a structural floor. The dollar is weakening. Real rates are low. Geopolitical risk is elevated. And every major bank on Wall Street is bullish. The crash was a positioning reset, not a fundamental reversal. The smart money is buying the dip. But let's talk about what could kill this rally. Because I'm not here to sell you hopium. I'm here to give you the full picture. First, if Kevin Warsh actually tightens aggressively as Fed chair, that could hurt gold. If he raises rates significantly and keeps them high for an extended period, real rates could spike above 2.5% or even 3%. That would increase the opportunity cost of holding gold and could push investors into bonds instead. Trump said he wouldn't have nominated Warsh if he favored rate hikes, according to Trading Economics. But we'll see. Actions speak louder than words. Second, if geopolitical tensions genuinely de-escalate, that could reduce the safe haven bid for gold. If the war in Ukraine ends, if Iran backs down, if tensions with China cool, gold could give back some of its gains. Not all of them, but some. Third, if the US dollar reverses its decline, that's bearish for gold. If the dollar strengthens significantly, it takes fewer dollars to buy the same ounce of gold, so the gold price in dollar terms goes down. But I think a dollar reversal is structurally unlikely given the $38 trillion debt and the trajectory of US fiscal policy. Fourth, if real rates spike above 2.5% for reasons other than Fed tightening, maybe because inflation comes roaring back and the Fed is behind the curve, that could also hurt gold in the short term. Though in that scenario, gold would likely still outperform most other assets because it's a hedge against currency debasement. Deutsche Bank's George Sua said the recent volatility was tactical, not a durable fundamental shift, according to finance magnates. I agree with that assessment. The fundamentals haven't changed. The crash was a function of leverage and positioning, not a change in the underlying drivers. Now let's talk about how you should actually play this if you believe the bull case. Because knowing the thesis is one thing, knowing how to position yourself is another. If you want direct exposure to gold, the simplest way is through ETFs like GLD or IAU. These are physically backed gold ETFs. When you buy shares, you're buying a claim on physical gold held in a vault. They're liquid, they're transparent, and they're easy to trade. The downside is that you're paying a management fee, usually around 0.4% per year for GLD and 0.25% per year for IAU. If you want leveraged upside, consider gold miner ETFs like GDX or GDXJ. GDX holds large cap miners. GDXJ holds junior miners, which are smaller and more volatile. As I mentioned earlier, miners have record margins at current gold prices. Their costs are fixed around $1,600 per ounce, and gold is trading around $5,000. That's a 3-to-1 margin. If gold goes to $6,000, the miners don't just go up 20%. They could go up 40%, 50%, or more because the incremental revenue from higher gold prices drops straight to the bottom line. The risk with miners is that they're equity, not the metal itself. They're subject to operational risk, management risk, geopolitical risk if they're mining in unstable countries, and they're more volatile than the underlying metal. But if you believe gold is going higher and you want more bang for your buck, miners are the way to get it. If you want exposure to silver, SLV is the main ETF. Silver is more volatile than gold because it has both monetary and industrial demand. It's used in electronics, solar panels, and electric vehicles. If the economy slows, industrial demand for silver could weaken, which would hurt the price. But if the economy stays strong and monetary demand kicks in, silver could outperform gold on a percentage basis. If you want to hold physical gold, you can do that through a gold IRA or by buying coins and bars directly. The advantage of physical is that you own the metal outright, no counterparty risk, no management fees. The disadvantage is storage and security. You have to store it somewhere safe. And if you sell it, you're subject to the collectibles tax rate, which is 28%, not the standard long-term capital gains rate of 15% or 20%. That's a big hit. My advice is to dollar cost average into the volatility. Don't try to time the bottom. If you believe the structural case, buy a little bit now, a little bit next month, a little bit the month after that. Build your position over time. That way, if the price drops further, you're not all in at the top, and if the price rips higher, you've got exposure. In terms of allocation, most experts recommend somewhere between 5% and 20% of your portfolio in gold, depending on your risk tolerance and outlook. I'm not a financial advisor, so I can't tell you what to do, but I can tell you what I'm seeing. The smart money is treating gold as a hedge, not a speculation. It's insurance against monetary instability, fiscal insanity, and geopolitical chaos. And right now, all three of those risks are elevated. Now let's talk about the bigger picture. Because this isn't just a gold story, it's a confidence story. Gold nearly doubled since Trump's inauguration. That's not happening because gold suddenly became more useful. Gold doesn't do anything. You can't eat it. You can't burn it for energy. It just sits there. So why is it doubling in price? Because confidence in US institutions is eroding. Ray Dalio warned that the world is on the brink of a capital war, where countries weaponize money and financial systems against each other. Gold, he said, is the best protection. That's according to Fortune. Western sanctions froze over $300 billion of Russian reserves. That signaled to every country on the planet that dollar assets are vulnerable to geopolitics. If you hold your reserves in dollars and you do something the US government doesn't like, your reserves can disappear overnight. That's a terrifying realization for a finance minister or central bank governor. And it's why they're buying gold. Gold can't be frozen. It can't be sanctioned. It has no counterparty risk. It makes no promises and is not dependent on political decisions. That's the Diego Franzen quote again, and it's worth repeating because it's the core insight. Vanek described what's happening as a shift in currency regime unlike anything in a century. The British pound was the global reserve currency until it wasn't. The US dollar has been the global reserve currency since World War II, but that dominance is not guaranteed forever. And the more the US weaponizes the dollar, the more the rest of the world looks for alternatives. Gold is the oldest alternative there is. It's been money for 5,000 years. Empires rise and fall. Currencies come and go. Gold endures. That's why it's rising now. Not because of technicals or chart patterns or momentum, because people are losing faith in the alternatives. And that's not going away. The $38 trillion debt isn't going away. The $2 trillion deficit isn't going away. The geopolitical tensions aren't going away. The weaponization of the financial system isn't going away. All of those things are structural. And as long as they're in place, the bid for gold is going to remain strong. Now let me tie all of this together because when you see how these pieces connect, everything clicks. The crash in gold and silver was a positioning reset, not a fundamental reversal. Leveraged speculators got flushed out when the CME raised margin requirements and when Kevin Warsh got nominated as Fed chair. That created a cascading sell-off. But the structural buyers, the central banks, the institutions, the long-term investors, they didn't sell. In fact, they bought more. $19 billion flowed into gold ETFs in January, a record month. Gold miner ETFs saw the largest inflow since 2009. The structural drivers are all intact. Central banks are buying 800 tons a year and they're not stopping. The US dollar is weakening under the weight of $38 trillion in debt. Real rates are low. Geopolitical risk is elevated. And every major investment bank on Wall Street just raised their price targets to a range of $5,400 to $6,300 by year end. The crash didn't break the bull case. It cleaned up the positioning and made the market healthier. The weak hands are gone, the strong hands are accumulating, and the risk reward is better now than it was at the highs. If you want exposure, buy GLD or IAU for direct gold exposure, GDX or GDXJ for leveraged upside through miners, or SLV for silver. Dollar cost average into the volatility. Don't try to time the bottom. Treat gold as a hedge, not a speculation. Allocate 5% to 10% of your portfolio, maybe more if you're particularly concerned about monetary instability. And understand that this is bigger than gold. This is about confidence in institutions. This is about the end of dollar dominance. This is about a shift in the global monetary order that happens once a century. Gold isn't rising because gold is special. Gold is rising because everything else feels fragile. Your future self, the one looking back on this moment 10 years from now, is going to judge you based on what you do next. Not based on what you know, based on what you do. The information is in front of you. The thesis is clear. The question is whether you'll act on it or just watch it happen. Silver, gold, the Fed, inflation. What's the next topic you want me to dig into? Drop it in the comments. That's what this channel is for. The smart money already moved. The question is, will you?